All right, let's jump right in. We're going to tackle a really interesting puzzle at the heart of the financial markets. You see some good news about a stock, and you'd think all the pros would be on the same page, right? Well, you'd be wrong. We're going to figure out why the smartest investors out there so often end up on the complete opposite sides of the same exact trade. Okay, so really think about this for a second. A company announces, I don't know, a massive breakthrough. You'd expect all that smart money to pour in to buy up that stock. But that's not what happens a lot of the time. For every huge fund that's buying, there's another one selling. They are all looking at the exact same piece of news. So what gives? Why are they making totally opposite bets?
So, to untangle this, we first have to understand a really key idea from financial research, and that is, not all information is the same. Actually, it turns out that financial news really comes in two very different flavors. On one hand, you have what's called cash flow news. This is all about a specific company and its ability to make money in the future. On the other hand, you have discount rate news. Now, this is about the bigger picture, the whole economic environment that changes what those future profits are actually worth to you right now, today. Let's break down cash flow news a little more. Think of it this way. It's like a company suddenly discovers it's sitting on a giant gold mine, a brand new patent, a product that's flying off the shelves, a surprise earnings report that blows everyone away. All of these things directly change how much cash we think that company is going to make. It's news about the company itself, plain and simple. Discount rate news, though, that's a whole different animal. Let's stick with our gold mine analogy. This is like a sudden change in the global price of gold. The amount of gold in the company's mine hasn't changed one bit, but what that gold is worth has totally changed. This is driven by those big market-wide things, like the Fed's changing interest rates. It affects pretty much everybody. Okay, so now let's meet the main players in our story. Because just like there are two kinds of news, the research shows us there are basically two main types of big-time investors. And we can think of them as the market's sprinters and its marathon runners.
And you can see right away, their whole approach is just different. The sprinters, they're all about those quick gains. They're trading all the time, constantly turning over their portfolio. The marathon runners, on the other hand, they are laser-focused on the long haul. They buy, they hold, and they really don't trade that much.
So let's look a little closer at our sprinters, or as the researchers call them, informational return chasers. I kind of like that name. Their whole game is a high churn rate, which just means they're constantly buying and selling. They also tend to be less diversified, so they're making bigger bets on fewer stocks. And they live and breathe by those short-term company-specific events. They're trying to get an edge and get it fast. And then you have our marathon runners, and they are pretty much the polar opposite. Their churn rate is super low. They're very well diversified, holding a whole bunch of different stocks. You see here their market beta is close to 1, which is just a fancy way of saying their portfolio tends to move up and down with the overall market. They care way more about those big economic tides that lift or lower all boats over many years. Okay, so we've got our two kinds of news and we've got our two kinds of investors. Now for the big reveal. This is where it all comes together. This is how we solve the puzzle we started with. Check this out. This is the sprinter's playbook. They react, and I mean aggressively, to cash flow news. Positive earnings surprise? They're buying. New patent? They're all in. But look at the reaction to discount rate news. It's almost nothing. They might even sell. Why? Because it's just not their game. And then, in total contrast, you have the marathon runners. They are way more sensitive to discount rate news. A shift in interest rates totally changes their long-term calculations, and they act on it. That company-specific cash flow news? Yeah, they notice, but it's a much smaller piece of their decision-making puzzle.
And this really gets to the core of it. This quote from the research paper just nails it. These two groups aren't just seeing the world through different lenses. They are literally on opposite sides of the table, trading with each other because of those different views. So here's how that looks in the real world. That positive cash flow news hits, and the sprinters go long. They buy the stock. But at the same time, the marathon runners might actually be selling. And then on the flip side, when there's discount rate news, say interest rates go up, the marathon runners might be buying, while the sprinters are selling. This is exactly how they end up on opposite sides of the very same trade.
Okay, so what's the big takeaway here? What does this constant tug of war between the sprinters and the marathon runners actually do for the market? It might seem a little chaotic, but it turns out this disagreement is incredibly important. In fact, it might even be a good thing. To get why, you need to know about this classic idea in finance called underreaction. For a long time, researchers noticed something kind of weird. When good news about a specific company came out, the stock price wouldn't instantly jump to where it should be. There was always a bit of a delay. And this was not a small effect. One study back in 2002 found that for every dollar's worth of good news, the stock price only went up by about 59 cents on average. That means there was a 41-cent gap just sitting there. That's a huge inefficiency in the market. But let's fast forward to the more recent period in the study. That gap, it's shrunk all the way down to just 18 cents. The market has gotten way more efficient. So the big question is, why? What changed? Well, the answer seems to be our sprinters. When that company-specific news gets released, they are the ones who pounce on it. They trade on it, and they trade aggressively. And it's all of that trading that actually closes that inefficiency gap. They are basically the engine that pushes stock prices to where they're supposed to be, faster, making the whole market smarter for everybody else.
And that leaves us with this really fascinating, almost paradoxical idea to chew on. Is it possible that you need these two totally opposite forces for a market to really be healthy? Does the relentless, maybe even short-sighted chase for quick profits by the sprinters somehow paradoxically create a more rational and efficient market for the long-term marathon runners? The research seems to suggest, yeah, the market might just need both to be at its best.